Welcome to the daily update. This is being prepared Monday, August 15th, where we'll look at the action in the market today and then see how things look for Tuesday, August 16th. And we had another up day. Started out kind of negative, but we were able to claw our way back and eventually eke out a gain. We're still starting to build more of that short-term overbought condition and a little bit intermediate term. I have some charts that will show you that. But our scenarios are still looking positive. They're still advancing. The sector rotation improved a bit after Monday's session. So things are still continuing to look positive, but we still have some pretty major overhead resistance above where we're at right now. All right, so let's go back and look at what happened on Monday. Right at the open, we had a gap lower, and we ended up getting down to the daily pivot at 42.60. We bounced between the daily pivot and unchanged level for a while before the market decided what it wanted to do. As the day went on, we actually went positive and made it up to R1, which was at 4,300. That's a psychological level. It also ended up being a resistance level in Monday's session. So this is helping to have things look more positive right now. We closed just off the high. We ended up being only up 0.4%, but it was still an up day, a little bit of a slower up day. Volume was below average, and that's still pretty much the norm for right now. Our technicals are positive, showing some overbought indications, showing that we have some overhead resistance where we're at. So there are just some things that we want to keep an eye on. Inflation and interest rates still continue to be the focus. We have a whole list of geopolitical concerns, which, as I always say, could immediately come to the forefront if any one of those ends up exploding. Earnings continue to come out, and then we have this debate going back and forth about recession. What does it mean, and are we in one? What are some comments that we can make? The sector rotation and our setups are positive and advancing. They did show some improvements. The 200-day moving average is still above the current price for the S&P, and we're becoming overbought. If we continue to go up, we get to that 200-day moving average, and we get into a pretty significant overbought situation, having resistance and the market a little overextended, that could turn things around. We'll want to see. Can we break through that 200-day moving average? That's the real line in the sand, at least on the daily charts, for the difference between positive and negative. We're coming up to that ever so slightly. The 2 to the 10 and the 2 to the 5, those yield curves still remain inverted. Fear is still in the neutral category. This was interesting. The dollar was up and stocks were up in Monday's session, which is kind of different than what we've been seeing. Oil has now dropped below 90. That helped give some support to the markets. We had the Empire State Manufacturing come out, and it was a lot weaker than expected. This is New York. Even though it's not a national economic report, New York's very important and controls a lot of different things. And so for it to come in at minus 31.3, down where they expected it to be up at 5. So that was a lot weaker than expected. And the NAHB housing index, they expected it to be at 55. It went even below that and came out at 49. So we're seeing weaker economic reports. We want to keep an eye on this because right now this is positive to have weaker economic reports coming out. That means that maybe interest rates won't need to be raised as much. The Fed doesn't have to be as aggressive. But at some point, we're going to take this, if it continues, this will go too far. And instead of this giving support to interest rates, either topping out or coming down, it'll get to the point it's like, okay, the economy is really not looking very good. And now we're going to take this negative news as bad news, where right now, these declines are seen as positive news. Our trend is still positive. The ADX continues to advance. We had an up day. Our bias is positive, and our momentum continues to be positive. Let's go back and look at sentiment. We're just on the edge of neutral at 55, and it just shows we're kind of midpoint right now. So we can kind of ride this. If we continue to see fear and greed, with the greed part starting to go up in this advance, we can ride that wave. And then when it starts to get toppy, that's when we look at taking a contrarian view of things. Here's another index. This takes a lot of different sentiment gauges together, and it's leaning a little bit more towards the greed side of things. Here's the buyback authorizations through the second quarter of 2022 that ended in June. It was about 800 billion as of the first half of 2022. Over here on the right-hand side, it just shows 767 billion were authorized. The markets ended up buying 616 billion back. So a little better than what we saw in 2020, not quite as good as what we saw in 2021, but still rather healthy overall. This is the percent of industry groups. These are not sectors. These are industry groups, which there's hundreds of those that are above their 10-week moving average. And this is showing a lot of improvement. This is suggesting that under the hood, the market is really starting to look more positive, but getting a little bit of extreme right now. Doesn't necessarily mean that we'll stop going up, but it could put a shorter to more intermediate term stall on things if this continues to get more extreme positive. These are the growth valuations against the value. They're comparing them in the Russell indexes, the Russell 1000 growth, and I have to cough, against the Russell 1000 value. And then it's a ratio between them and looking at their price to book. Now, I won't really go into what that means right here. This is just another valuation that you use to see is a company expensive or inexpensive. But these numbers are still quite high. Even though they dropped, they've been bouncing back up. So this might suggest that things are still historically high right now on a valuation basis. This looks to me like the same chart that I showed a couple days ago. This is just suggesting that short interest in the S&P is pretty low. We don't have a real long chart of this to get some historical perspective, but it's at 1.7, and that just means the folks that have actually gone short in the S&P. And since this is so low, it wouldn't give a lot of support. If we start going up and you hear this thing called a short cover rally, there's not a lot of shorts right now that would help push things a little bit higher. We would like to see this percentage even higher than it is, because if we do really move upward, those folks have to come in, they have to buy to close out their positions, and that pushes prices even higher. Sentiment still showing some improvement, where it just shows light positioning right now. We're still negative overall, very similar to the other charts that we've been seeing, like the AAII, where they were extreme negative and are starting to show some improvement. The jobless claims, not really a lot new here. It just shows that we're below average overall. And we're kind of following the seasonal norms when they go up and down slightly. But overall, this dark blue line is well below what they've been in the recent past. These are the S&P sector returns from the 5th of August through last Friday. On the 12th, it just shows energy. Energy has been still performing quite well. All of the sectors are advancing. This blue bar here is the S&P 500 itself. So just gives you an overall health. This is somewhat similar to the sector charts that I show. Here are the value area. The value area over on the left with the large caps was up 0.27. Growth was up 0.55. So growth outperformed value in the large caps, and also with the mid caps and the small caps. So this will help our sector rotation scenarios to improve. The VIX is still right around the 20 level for the S&P, and the VIX of the VIX is also still slightly below the moving averages and starting to decline a bit, which is pretty normal for an up day. The Ulcer Index, the daily chart, not helping us, where the weekly chart still continues to be about where sentiment is at right now. We're down 10.82% from the all-time high. Our equity put call ratio bounced up a bit. A lot of that may have happened right at the open when people were starting to hedge some things. But our 5-period moving average is pretty much flat from Friday. Here are the pivot points for Tuesday's session, both the R1 and R2, S1 and S2. This is showing that we have been able to get back above this longer term resistance. And these lines have been on here for a long time. We came back up, we got above R1. Now we've been able to close above R1. We have this descending trend line right here from the all-time high to the high that was set back in March. And we have the 200-day moving average all kind of converging right here. If we continue to get overbought and come up to this level, that could produce some kind of a pullback. If we can break through that, that would even make things more positive. Here are the daily pivot points with the updated chart with the calculations set for Tuesday. Fib retracement, we were able to break above this 50% retracement going back to the low in 2021. So this is just showing how things have been improving. Here is another look going back to the COVID low to the all-time high, and then another low set in 2020 back to the COVID high. We're breaking through this resistance, and this is what we needed to see if things were really going to turn around. We still have this resistance over us that we don't see on this chart, but we are still starting to take care of these other resistance areas. If we start to fall, the hope is that some of these that were resistance now become support. Our sectors, where we had staples were up, and nothing was up more than 1% on the day, but energy, it ended up being down 1.95% overall. Here's our scooter scores showing that utilities and energy and industrials are looking the best from a technical analysis standpoint. Communication, although it's improving, is still well in last place. Here's the energy sector, which is, again, kind of bouncing around these days, but still the overall leader with the sectors in 2022, followed by utilities. Staples are just slightly negative, and we have communication and discretionary, which, especially discretionary, has been showing some improvement, but they're still down heavily from the all-time high. This is going back, looking at the indexes from the all-time high in January. Nothing really has changed here, with the NASDAQ and the NASDAQ 100 being down the most. They're also the ones that are kind of roaring back with the most enthusiasm currently. Technical alerts. We had the S&P had a BPI cross above 80. That's positive, but now starting to look extreme positive. And we got slightly above 4,300. Oil dropped below 90. Gold dropped below 18. And the cyclicals also went above 80. The NASDAQ first went below 13 now, and then later on it went above 13.1. Our intraday chart shows that we did have a gap lower down to the pivot. That ended up being pretty good support for the day's session. We went back up to unchanged, kind of came back down. And then finally, we were able to break through the unchanged level and go positive. We made it up to R1 and then bounced back a little bit from that, but we're able to close right near R1 and just slightly off the high. Our trend continues to be positive with the ADX advancing and the green line on top. The Arun shows green on the top, that's positive, and the decrease in selling. So overall, our oscillator is advancing above zero. So this is also showing a lot more positive action. Breadth really showed some improvement. Nice little advance based on price. We're crossing above the moving average based on volume. Advanced decline ratio, looking a little bit toppy right now. The blue 39 EMA, it has really shot up, where the red still has a little ways to go. New highs, new lows, seeing a bit of a breakout. So our 5-period continues to advance and our 10-period continues to advance. This is helping because we were going up higher, but not really seeing much of an advance with the new highs. Well, now we're starting to see that as we're breaking into price areas that we haven't been at for quite a while. Accumulation distribution. advancing and above an advancing moving average. Looking at some short-term charts where we had gone extreme with the advanced decline ratio after Friday, well, we worked some of that off in Monday's session. Rate of change 5 periods starting to look a little bit extreme. So this is short-term. Maybe we've overdone it, but this still could go higher than it is right now. Our moving averages, we're starting to get closer to the 200-day simple moving average. We're not there yet, but we're seeing all of these moving averages underneath start to turn up, starting to cross each other. And this is hopefully helping the overall picture to look more positive. The rate of change going back 20 periods, roughly 1 month, it is still extreme positive. Stochc RSI and the Williams percent R continue to be extreme positive. So this is the short-term overbought that we're looking at. Force index actually declined slightly. Swinland trading oscillator advancing based on price and volume. McClellan oscillator also looking a little extreme, even though it declined slightly. The 20-period EMA looking extreme, 50 extreme. The 200-day exponential moving average actually declined slightly. This is another area that's short-term overbought with the stochastics, with the short-term, intermediate term, and the longer-term stochastics. Looking at the intermediate term, this is kind of a little different than what I showed in the previous video, where our 19-day exponential moving average of the advanced decline line, it had gone extreme negative. And then this just shows some real strength. We went extreme negative all the way up to extreme positive, both based on price and volume. This could be short-term overbought, but this also could suggest that some strength is really coming back into the market. So if we work off this extreme reading, that could still suggest for prices to continue to advance. The Sean trend meter, pretty much flat right now. The PMO continues to advance and starting to look a little extreme, advancing based on price and volume. The PMOs that are rising, little extreme. Buy signals, extreme. And the PMOs above their 200-day or percent above zero continue to be positive, but looking extreme. Chaikin oscillator, we had saw a bit of a negative divergence here where the S&P was going up, but the Chaikin oscillator was going down. It finally turned back up. Chaikin money flow, kind of the same thing, was showing some weakness, but then we saw some rebounding on Monday. Volume just continues to be anemic. The vortex continues to be positive. Summation index based on price and volume continue to be positive. The slope is still having a little bit of trouble. It's trying to cross over negative, but yet trying to stay positive kind of at the same time, where our other oscillators are still looking much more positive. The BPI, this is where it crossed slightly above 80. So now it's looking a little more extreme positive, but still it is positive. Ease of movement showed some improvement. Ultimate oscillator advancing. Money flow getting very close to being extreme positive, but still advancing. The CCI 14 and 20 continue to be extreme positive, but they could still go higher than this. RSI, same thing, starting to look extreme with the 14 and the 9, but there's nothing to say that they have to stop here. They could go up a bit higher. This is just something we want to be aware of. The boom indicator also starting to look extreme positive when you're looking at the 50-period moving average. This could go higher as well. This is showing some strength that we haven't seen in a while, but on a short-term basis, we might be overdoing it, where the 200-day moving average is finally crossed above zero and is starting to look more positive. The TTM squeeze, it's looking a little bit, see, when it turns dark, that's a little bit negative. It's kind of goes counterintuitive. And here's the 50-period moving average. I'm sorry, the 200-day moving average. We're coming right up to that. So we're seeing a little tentativeness ahead of that. But with our Heiken Ashi, still positive. Kegi, positive. Renko, positive. 3-line break, positive. Added a new X with the point and figure chart. That's positive. Elder for the SPX, positive. SPY, positive. SAR, positive. Go, no go, positive. Kind of like a broken record here. These are the longer term moving averages where we're trying to come back up into these longer moving averages, but this is showing some improvement. These are much longer. So if we can stay above this and start to see these moving averages roll up and get it back to the point where it looked like it did in 2020 and 2021, that would be much more positive for the market. 50 period, looking extreme, 150. Actually declined, but still extreme, where we were pretty much flat with the 200 simple moving average. Special case starting to turn up. It would be a lot more positive if we could cross above this moving average, but that takes a long time for that to do. The diamonds, positive. Here's the Dow. We were able to break and close right on the 200 period moving average. This is kind of the line in the sand. The Dow's a very important index. Are we going to be able to break above that, or have we exhausted ourselves, at least for a little while, and will we fall back down? The Qs also are positive. They're not up to their 200-day moving average, but we still have that right at the R2 level. They're right on top of each other, but the Qs still remain above R1. The Vixen continues to fall as the Qs advance. The NASDAQ, kind of the same thing. We're above R1. We're not at the 200 yet, but are we going up a little too far too fast? With this, the mid caps are above their 200-day moving average and slightly above R1. This is quite positive, and we're seeing the same thing here with the small or the Wilshire above R1, not at the 200-day moving average yet. We're seeing it with the small caps that I'll show you here later. The dollar, this is one of those interesting things. The dollar had a strong upward move and stocks advanced at the same time. So this is just working itself more back to neutral, where the dollar, at least they're kind of a little bit going in opposite directions, but in Monday's session, since they went in the same direction, that's why this spiked up and it's getting back more to a neutral reading. Gold, which had been doing a lot better, really declined 1.29%. Silver also was looking better. It declined 2.56%. Oil has dropped below 90. It's at 89.41. Bonds up slightly, not any gangbuster moves, but are still showing some improvement. The World Bond Index was actually down a little bit, but still trying to bounce up based on price. Here's the stocks to bonds correlation. It's also starting to wear off, but they're tending to go more in the same direction. Our yield curves, this is the same thing. We still have the 10 to the 5 inverted. The 10 to the 2 is inverted. We're watching the 10 to the 3 month, and it's inching ever so closely down here, but it's still not inverted. The tech sector to the 10-year, wearing off a little bit and working its way back towards neutral. We saw some of the longer term maturities, the interest or the yield declined, where the shorter term maturity really spiked up. And that's why we're seeing a lot of this inverted stuff going on. Our scenario still looking okay with the stocks above their 200-day simple moving average. So that's still holding up. Those that are above their 50 continues to spike up, maybe a little overextended in the short term, but going from an extreme negative reading to an extreme positive reading in a short period of time, that is a thrust move, and that could be positive longer term for the S&P. This is really the same chart. This is just saying a very rare but very bullish development where more than 90% of the S&P components are above their 50-day moving average. That's what this chart is showing, but they're showing it when this has happened before, how the S&P has performed after that. And typically it's quite positive. The mid caps, not really extreme, but still showing some improvement, and the small caps also. So we're seeing some rare events happening in the S&P, and we're seeing confirmation from the small caps and the mid caps. This is the 10-day average of the highs and lows in the S&P, also continuing to advance after giving an extreme negative reading. This is very, very broad, where the 5-period moving average of the highs to lows continues to hold up quite well. The equity put call ratio after spiking continues to fall. There's the small caps, slightly above the 200-day moving average, and just a little bit above R1. Here's the small cap to S&P 500 ratio, still showing some improvement. And here we have the red chart showing a spike up, which has been providing some support to the S&P, the blue chart. Then the S&P to the 10-year yield declined just a little bit. They're having a tendency to go in the same direction. The Copic curve is still flashing its signal, and it gave us that signal way back in June, and that has been a really solid signal since then. Our sector rotation, advancing again with the Qs to the SPY, discretionary advanced, and growth over value advanced, with all of the moving averages continuing to go higher. Large, mid, and small caps also showing some improvement. After seeing a little bit of a negative divergence on Friday, it's still there with the mid caps and the small caps, but at least they turned up slightly. The correlation between the S&P and the 2-year starting to wear off and coming back down closer to neutral. The spike, we don't really know here. This spike is still there, but we want to see this really fall, and it's just not falling yet. Where the staples, they were up almost 1%. Are they starting to improve? So here, this is the chart, again, that I've been really focusing on, where we spiked up, we're coming down. We saw just a tiny bit of a bounce in the ratio. All right, so what's our outlook for Tuesday? The technicals are positive. They're becoming more and more overbought, and the 200-day simple moving average is above where we're at right now. If we see a convergence of a more overbought condition, when we get to the 200-day moving average, that could add to that being real resistance if we hit that level. Sentiment is still pretty much neutral. We have housing starts and building permits coming out on Tuesday, industrial production and capacity utilization. It's also coming out the whole list of concerns. Just pause this. I feel like a broken record because they're the same things, where the biggest one is inflation and interest rates. But any one of these other ones could always come to the forefront depending on what happens. Our scenarios, we're not in a down scenario right now, even with all of these potential headwinds. We are becoming a little bit more overbought, and we have overhead resistance. That could at least produce some kind of a short-term downward movement if that ends up happening, because the technicals are positive. So we're not really in the negative scenario. We are in the up scenario or positive scenario because our technicals are positive, but they're starting to become overbought. You still have a lot of people who don't believe this. And if we do somehow break above that 200-day moving average, you're going to have a lot of FOMO kick in, the fear of missing out. This is what a lot of people, including a system that I teach, that you go long when you close above the 200-day moving average. And you're going to have a lot of people who kick into gear if that happens. We're still a ways away from that, and it could take some time for this to play out. We just want to be aware of this. Our scenarios are showing some more improvement. Even though we had a stronger up day on Friday, they actually showed more of an improvement, at least with the sector rotation in Monday's session. Technicals are still looking good. We're above most of the moving averages. The pivots, some of the indexes are working above those. Some still have that as overhead resistance. And we're not sideways right now with the ADX going up. So our conclusion then is the S&P is positive, but becoming short-term and even intermediate-term overbought. This is the same as after Friday's session. It's just a little more so. Short-term, becoming more overbought, even though it's positive. Intermediate-term could be becoming even more overbought. But as long as we're below the 200-day moving average, the S&P is still negative in that regard. So thank you. Have a wonderful Tuesday. And if we end up having a real nothing day, I might just do a daily brief. If there's some significant price action where things really look to readjust, then I'll likely do a full-blown video and the daily brief as well.